It was one of those corporate India days where three storylines collide: money getting raised, control changing hands, and a very mixed earnings season underneath it all. And hovering above everything, AI and policy, because everyone wants to sound future ready while they still have to deliver cash flows this quarter.
And markets are in that jumpy mood too. Gold at a lifetime high, equities having a rough start to the year. So when you see fundraisers and open offers, you've got to ask, is this confidence or is it balance sheet anxiety?
Let's start with the most controlled headline, Restaurant Brands Asia. There's an open offer to buy 26% at 70 rupees a share, up to about 1,456 crore rupees, taking the acquirers to roughly 61% if it goes through.
That's not a casual top-up. That's we want the steering wheel. What's really going on here? Are they trying to stabilize operations or are they saying a valuation window and grabbing it?
Likely both. What makes it more interesting is the capital stack around it. Restaurant Brands Asia is also talking about a roughly 1,500 crore rupees preferential equity issue and increasing authorized share capital, subject to shareholder approval.
Which is where my skepticism kicks in. Open offer plus fresh equity. Great if it funds store expansion and fixes unit economics. But if you're doing it because the business needs oxygen, minority shareholders should watch dilution and what price the preferential issue lands at.
Also, the bulk and block tail tape had Restaurant Brands Asia featuring prominently today. That usually signals positioning ahead of corporate actions. ARBS, funds reshuffling, maybe some event-driven money.
And there's a narrative layer too. ET now mentioned Inspira Global acquiring a controlling stake in Burger King India. Even if that's more of a strategic headline than a detailed transaction note, it tells you quick service restaurants are in a who owns what phase, not just who sells more burgers.
Exactly. Consolidation and control cleanup tends to happen when a sector matures and growth gets harder to buy with discounting.
Or when funding conditions tighten and everyone wants a stronger sponsor behind the brand.
Speaking of funding conditions, today was basically a mini parade of capital raise approvals. JSW Energy allotted shares and warrants worth about 1,125 crore rupees to JTPM metal traders.
Energy companies raising money is never just, we like growth. It's also, CapEx is relentless. Renewable build-out, storage, grid connectivity, cash gets consumed fast.
Bazaar Style Retail ने approve किया एक preferential issue of convertible warrants about 331.5 crore rupees to Cupid Limited.
Retail plus warrants always makes me ask, is this expansion capital or is this a promoter alignment play? Warrants can be a slow-motion equity infusion and the terms matter more than the headline number.
And 5 Paisa Capital got board approval to raise up to 500 crore rupees via equity, debt or other securities.
That one's telling. Brokerages and fintech-ish platforms are realizing customer acquisition is expensive, and product breadth, wealth, lending, everything needs capital and compliance spend. The platform story burns cash unless you hit serious scale.
Which brings us neatly to the most scale-heavy results update today, Jio Financial Services. Lending AUM up 4.5 times to 19,000 crore rupees. Disbursements doubled. Jio BlackRock AMC hit 15,000 crore rupee AUM in 6 months with 10 funds launched. Payments total payment volume up 156% year-on-year. Deposits nearing 500 crore rupee. And net income from operations up 320%.
Big numbers, but I want to slow down and ask what's really driving it. Is this organic customer pull or is it distribution leverage from the Jio ecosystem doing the heavy lifting?
Probably the ecosystem. And the strategic direction is clear. They're pushing beyond payments into wealth management and insurance broking. And they're leaning on AI-driven growth.
AI-driven growth is the phrase everyone uses. But in financial services, the real question is underwriting and risk controls. Growing AUM fast is easy when credit is loose. It's the loss curves that tell the truth later.
Fair. Though the AMC AUM ramp is a different animal, their distribution and brand can create a flywheel without taking balance sheet risk.
Unless fee compression hits, because passive pricing and competitive active funds can squeeze margins. Still, getting to 15,000 crore rupees in 6 months is a serious start.
Now, staying with results but shifting tone, today's quarterly picture across companies was mixed. You had strong revenue growth and margin improvements in names like Anantraj and KEI Industries, record revenues and margin expansion.
That's the execution is working bucket. Real estate-linked plays and industrial cables doing well usually signals capex, and construction activity still has pulse.
Bajaj Consumer Care and Tattva Chintan also showed robust double-digit revenue growth and margin surges.
Which is interesting because a consumer is supposed to be patchy. When a consumer name posts margin surges, I immediately ask pricing power, input cost relief, or just a low base.
On the financial side, Bank of India and Dhanlakshmi Bank improved operating metrics, better margins, asset quality, helped by capital raising and cost control.
That's the boring is backstory in banking, but I'd still watch deposit costs. Everyone can look good for a quarter if credit growth is strong and slippages behave.
And then there were the margin pressure stories. Sagar Cements and Vent India saw operating margin declines despite revenue growth because costs rose.
That's the part investors keep underestimating. Revenue growth isn't the same as earnings power when input costs and competitive pricing bite. It's also why so many management teams are obsessed with operational efficiency right now.
One company-specific update that mixes earnings with governance. Eternal Limited posted Q3 FY 2025 revenue of 16,315 crore rupees and net profit of 102 crore rupees. And an announced CEO and MD Dipinder Goyal is resigning effective February 1st, with Albinder Singh Dhinsa stepping in as CEO the same day.
That's a big personality shift. When a founder CEO exits, the question isn't just who's next. It's what changes. Strategy, risk appetite, culture, everything can get rewritten.
True, though sometimes it's also a planned transition to professionalize and scale. We don't know the backstory here, so we should be careful.
Careful, yes, but markets won't be. They'll immediately price uncertainty. Is it performance pressure, board dynamics, or a pivot that needs different leadership?
In contrast, Rajratna Global Wire reappointed Yashovardhan Chordia as CEO and Deputy MD for 3 years, starting April 2026, with a focus on expanding global operations.
That's the opposite signal. Continuity, and we know what the plan is. Reappointments don't move stock dramatically, but they reduce execution uncertainty.
Let's do a segment on orders because it shows where government and industrial spending is landing. Centum Electronics got a 29.4 crore rupee contract from Garden Reach Shipbuilders for advanced naval navigation systems.
Defense electronics is one of those areas where small orders can be strategically huge. Qualification, relationships, repeatability. The rupee value today matters less than the vendor credibility it built.
Premier Explosives secured an international order worth about 17.7 crore rupees for rocket motors.
Again, a capability signal. International order plus rocket motors. If execution is clean, that's a calling card.
RMC Switchgears got a 27.94 crore rupees letter of intent for FRP fencing supply in Maharashtra, and SBC Exports got a repeat export order of 7 crore rupees from a Dubai garment firm.
Those two are more bread and butter, but they tell you something. Infrastructure procurement continues at the state level, and exports, at least in pockets, are about repeat customers, not one-off wins.
Also, a small compliance note, Ashiana Housing disclosed a GST audit liability of about 24.6 lakh rupees, mostly paid, remainder under verification.
Tiny number, but it's a reminder that real estate companies live under a microscope. Audits, classifications, input credits, governance hygiene matters.
Now zooming out to policy and macro signals, there's a strong India wants to be AI-ready drumbeat. India being recognized as a top AI-ready country, pushing cost-effective models and GPU partnerships with a focus on productivity and skills, and techno-legal governance.
The GPU partnership angle is the tell. Everyone's realized AI ambition without compute is just PowerPoint. The real question, can India secure enough compute at reasonable cost, and can it avoid a regulatory mess that scares companies away?
Related, the Tri-STPI pre-summit on AI in telecom talked about network automation, customer engagement, and ethical deployment.
Telecom is a perfect test case because AI can cut costs and improve service, but it also raises surveillance and bias concerns. Ethical deployment sounds nice until someone asks who audits the models.
On the power side, the Ministry of Power is emphasizing financially robust DISCOMs and has put out the draft National Electricity Policy 2026 for consultation. Long-term goals around renewables, financial viability, and universal electrification by 2047.
DISCOM reform is the perennial bottleneck. If DISCOM cash flows don't improve, renewable generators and transmission players feel it through delayed payments. So policy talk is good, but execution is everything.
There's also a trade and geopolitics layer today. India and the EU are said to be close to finalizing a historic free trade agreement, creating a market that's nearly a quarter of global GDP.
If that moves from close to done, it changes boardroom math. Autos, chemicals, pharma, textiles, even data flows depending on clauses. But FTAs also create losers. Domestic industries will push back if tariff schedules bite.
The Ministry of Commerce also highlighted India-Myanmar trade talks aiming for $5 billion bilateral trade by 2030, plus conferences on trade in the global energy transition and IP governance.
That's India trying to be a rule shaper, not just a rule taker. But again, companies care about the practical bits. Logistics, customs friction, and whether cross-border payment and compliance are predictable.
दावोस में हनीवेल सीईओ विमल कापूर ने ग्लोबल ट्रेंड्स पर बात की और इंडिया की रोल पर भी हाईलाइट किया बिजनेस स्ट्रैटेजीज में। मार्केट आउटलुक की बात की जाए तो 2026 के लिए कॉशियसली ऑप्टिमिस्टिक है, डिस्पाइट अ फ्रेजाइल एनवायरनमेंट और एक 3.5% के डिक्लाइन इन इंडियन इक्विटीज में ईयर की शुरुआत में।
Davos optimism is cheap, cost of capital is not. The interesting signal is that despite the shaky start, people still think India can outperform, meaning global allocators might be looking for relative stability.
Quick hits before we close. The Cotton Corporation of India posted turnover of 20,009 crore rupees in FY25 and paid an 8.89 crore rupees dividend to the government while expanding MSP procurement and improving traceability and digital systems.
That's quietly important. Traceability in cotton links straight into textile exports and compliance demands from global buyers. It's not flashy, but it's infrastructure for competitiveness.
The government also integrated the Sampan pension portal with Umang and DigiLocker. About 4 lakh pensioners can access documents and status online.
Digital public infrastructure doing what it's supposed to. Reduce friction, reduce corruption, surface area, and make services auditable.
Market microstructure note, the volume shockers list had Kalyan Jewelers, Credit Access Grameen, Supreme Petrochem, Deepak Builders, Pashupati Caught Spin. Unusual volumes in Kalyan Jewelers also saw notable share decline.
Volume plus price drop is usually either panic, positioning, or someone knows something, though not always. It's a watch list signal, not a conclusion.
And Indigo apparently resolved operational issues with no flight cancellations post-February 10th, which is operationally reassuring.
Airlines live and die by operational reliability. Fixing it is good, but the sector's economics are still brutally sensitive to fuel and pricing.
So what's the one takeaway today? Corporate India is simultaneously doing 3 things: raising capital to fund capex and platforms, reshuffling control and leadership, and trying to sell a future story. AI, trade, infrastructure, while quarterly margins are still being fought in the trenches.
And the subtext is discipline. The winners in this environment won't be the loudest AI adopters or the biggest fundraisers. They'll be the ones who can raise money without scaring shareholders, grow without losing margins, and change leadership without losing the plot.